Welcome, everyone. Welcome, all my entrepreneurs. I'm so excited to be here with you guys today. And I feel like you guys embrace me and allow me to provide some coaching and guidance to your business. So thank you for that. And at the end of the day, what we're trying to do is to make sure that you guys are business ready, contract ready, and bank loan ready, even grant ready. Okay. That's what we're trying to do. So today we have a very special presenter, and she's one of our business coaches as well. Her name is Gloria, and she's going to talk a little bit about pricing today, but she's going to present a little different perspective so you guys can look at how you run your business, how you do your pricing, and see how you can use that to step up your game. Now, as you know, every week I try to give you guys some goodies. So at the end, after Gloria's presentation, I'm going to be talking to you guys a little bit about the Verizon grant. I know I mentioned it to many of you before, but now I got some good details, some good information on it, and I want to share that with you guys. So we'll talk about that after the presentation. So without further ado, I'm going to go ahead and introduce our presenter today, and she'll tell you a little bit about her background, her bio, and we'll take it from there. So Miss Gloria June, without further ado, welcome. It's all yours.
Well, thank you, Gilbert. And I will share for a moment. Presenter view, hold on. A moment. Okay, so I think you could see the presenter view now, right?
Yes.
Okay, good. Well, thank you for giving me the opportunity to meet with the team today. My name is Gloria Jum. I am a CFO and a profit strategist. And often people say to me, what's a profit strategist? I think we have a lot of coaches out there who do work with small businesses on scaling and increasing their revenues. But often I see there is little emphasis on profitability, and that's where I come into play. Now, before I worked with small businesses, I spent most of my career in corporate America, almost 20 years in corporate finance. And now I have the benefits of being able to leverage the rigorous financial requirements that I learned and I implemented on that scale into small businesses. Also, most importantly, I worked in my husband's small business as his CFO for years, and I am from a family of entrepreneurs. Okay, so today I would like to walk you through the process of measuring the effectiveness of your pricing strategy. And by that, I mean, I want to walk with you through a process of ensuring that your price strategy actually covers the cost in your organization. Now, depending upon the industry you're in, or even maybe how long you've been in business, the unique contractual requirements that you have in the work you do with your customers, you all may approach pricing a little differently. But at the end of the day, regardless how you approach it, at the end of the day, you want to ensure that your pricing, your volume, and your profit will allow you to cover your monthly business expenses, right? And then most importantly, think about your goal. And that goal will look different to everyone. And some of you probably don't need or you don't care about money, and that's okay too. Some of you may be part of a nonprofit organization. Whatever it is, many of you though probably started your business to create some level of wealth. So you need to ensure that you've created a business model that is sufficient to meet your annual expenses and your retirement, okay? And I think I mentioned earlier that I grew up in a family of entrepreneurs, and I often saw the inconsistency and the difficulty managing finances. And even as an adult, when my husband decided that he needed to start his business, fortunately, with my background, I immediately jumped into action. And my question to him was, let's put it on paper. I want to see how much you expect to bring in for revenues. Let's create a budget. Let's make sure that you have a consistent salary. Let's make sure that you have a 401k. So these are some of the things that I did when he first started his business. What I'd like to know is, and wow, I don't know if I could see it. I wonder what type of businesses you have. And Gilbert, you may need to help me and tell me, could you, the attendees, could you write in the chat what type of businesses you represent? And Gilbert, could you help me and tell me what you see? It's
Sure.
hard for me to read the chat.
Sure. We got pet product startup. We got consulting firm, tech company, catering business, childcare, videography, supervisor's corner, branded promotional products, chiropractor, medical device business, catering again, laundry, dry cleaning service, tax consulting, Thai restaurant, Airbnb, towing company, bakery, nail salon. You get the gist of it, right?
Yes, they represent all spectrums
Yes.
of our economy. This is great. But also I have another question, and Gilbert, you'll help me. From a scale of 1 to 10, 10 being you're ultra confident, what is your level of confidence in how you go about pricing for profitability? And do you believe that your pricing actually
Ginger
works?
said 5, Jessica said 7. Oh, they're going fast. Diana said 5. Biana said 7. Anthony is a 4. Lori is a 5. Brian Williams said a 9. Micah Anderson is a 4. Violet Minor is a 5. Diana Andrews, or Dina Andrews, 7.
Okay.
So you get it, right?
I got it. I got it. So the middle of the road.
Yeah.
Okay. So thank you, Gilbert, for helping me here. So as we approach this presentation today, I'd like to walk through 4 different segments, starting with the strategy, and I will go on to price points and the cost of the product and the product mix and operating expenses. I really want to take a holistic view of the pricing concept, okay? Now, when you say, where should I set my pricing? You know, what should I charge? What if I charge too little? Or what if I charge too much? The funny thing is that charging too little or even charging too much may have similar implications. It may cause you to be in a situation where you will have difficulty luring customers. You may actually drive your customers away, right? Because the customers, if you price your product too low, your customers may have a level of wariness about the quality of your product. For example, in the last year, I was speaking to one lady and she was considering, she does resumes for a living, and she was actually considering pricing her resume at $25, right? Now, unless you as a consumer, you have an intimate relationship with the business owner, you probably would be wary about a resume writer charging you $25, right? And also, as a business owner, if you're charging $25 for a resume, the number of resumes that you need to write within a particular period of time in order to even eat in the city of Los Angeles, it becomes a really, really difficult situation. And so one thing we have to consider is when you price your product, you have to make sure it will create a situation where you're not going to be cash poor, you're going to have challenges with your cash flow, okay? Now, in terms of, moving on to your pricing objective, this is something that should be very well thought out and intentional. This is not a situation where you could constantly change your pricing from a week-to-week basis. You need to implement your strategy and give it a while for it to work, right? And if you're finding that it doesn't work, you then change the strategy. But for example, as you're developing your pricing objective, you need to ask yourself some hard questions. So for example, are you trying to increase market share? And keep in mind that I think many of us on the phone here today are small businesses. And as small businesses, it's really hard to compete to gain market share because it requires a lot of work. And very often you don't want to get into a price war with a larger company, okay? Another thing you should consider is when you're figuring out your pricing objective is, are you pricing for profit? And this doesn't require too much additional comments. Another thing you should consider is, are you pricing just to recover partial cost? And by that, I mean, I'm sure you've heard of the concept of a loss leader. Think about HB Ink, right? They produce printers and ink. The way they price most of their printers, especially their home inkjet computers, very often they don't even cover the cost of the printers. But that's okay. It's an intentional decision on their behalf. They basically want to place a printer in every home, and they know that every home will be forced to purchase higher priced ink and toner products. And therefore, it's a mix. It's part of their portfolio. It's well thought out. They know exactly how many printers they're putting out on the market within a particular period of time. So it's something that is done very carefully and intentionally, okay? Another price objective is, of course, maintaining quality leadership. So for example, if you are a Gucci brand, you will price at the higher level, right? And your packaging and everything will be indicative of your product. You will constantly explain and communicate to your customers why your product is worthy of the prices that you're charging. Another pricing objective to consider is aligning to competitor pricing. So basically it means that competitor XYZ down the street, potentially you will say, I will price similar to this competitor. But that's a challenge, and that's risky, because very often you don't understand that competitors' cost profile. So you need to be very careful before you embrace a strategy of simply matching the pricing of your competitors. And lastly, in terms of surviving unmanageable situations, let's assume that you have high levels of inventory of products that are not selling, right, you may have to make a temporary decision just to mark down the products just so that you could get rid of them, okay? But at the end of the day, whatever your product, your pricing objective is, it is important that you document, you place it on paper. You don't simply decide this is what you're going to do. You want to do your cost analysis, your pricing analysis to determine what are the implications of the prices that you decide to charge your customer. Okay. And then next, I would like to go to types of pricing. One of the areas we talk about is cost-based pricing. And this basically means quantifying the cost of the product. What does it cost to make that particular product or service? And simply adding a markup. And that's common in some industry, maybe some governmental contracts. It's usually not a recommended way of pricing your product. Then you have customer-based pricing, which is called value-based pricing. And this is similar to understanding what the customer is willing to pay and setting your prices accordingly, making sure that you do your research, okay? And this, in order for this to be successful, you really have to bring out your differentiation. In other words, what is your special sauce? What value you bring to your customer and what makes your product unique, okay? And in that situation, of course, there is less consideration of the cost of the product because you really want to maximize, your prices. And I think, you know, in my real life, I even had to test this concept when I first started offering my services out on the market. And unfortunately, when I first started, while my prices were decent, they weren't high enough as far as I'm concerned, right? Because the more research that I did, the more I realized that there was an opportunity for me to increase my prices. And it's constantly trying to get feedback from your customers, right? After you've completed the services, sometimes you may want to say to your customer, you know, what value did you get from my product or service? If we were to do this again, how much are you willing to pay? And also, I'm part of many finance communities where people do similar things that I do, and we talk about those things. And that's why it's really nice to have mentors and peers that are part of the same industry that you belong to. So it's a constant discussion and dialogue. Of course, you should not be changing your prices every other week, but you know, when you know better, you're supposed to do better, okay? And lastly here, we have competition-based pricing. And of course, this is follow the leader. And again, in this situation, you probably do not have much control over the pricing. And as a small business, you're really trying to, this is probably not the most effective pricing strategy for you. And again, as we move on to the end of this session, one thing I want to talk about is some of the most common pricing mistakes I see are the ones where there's simply no strategy, right? No strategy, or businesses that don't stick to a strategy. They may implement a pricing strategy one week, and don't give it time for it to work, and they're immediately making changes. It causes a lot of confusion, okay? Another problem is underestimating the cost of doing business, because if you don't have a good sense as to the cost of your product, you are not going to know what the gross margins are, okay? And then competing only on pricing, and this is where we talked about value-based pricing, you know, knowing what the customer is willing to pay and pricing your product accordingly, knowing what value you give to your customer, and simply communicating your value to your customer, so you're not simply just deciding that you will match the price of your competitors. And lastly, of course, is not checking the effectiveness, okay? And again, to do that, of course, I hope many of you do manage your financials, do check your financials. You have access to an online financial software, or you have a relationship with a bookkeeper, and we will talk about that a little later, okay? And the next section, I would like to, now that we've completed the strategy section, I would like to talk about price points, okay? And in other words, what is your optimal price point? And, you know, as small business, we're all small business owners here for the most part. And we often assume that when we have a revenue issue or profit issue, the answer is always to maximize the number of units. Try to get more and more and more and more sales. But we see very often that sometimes the answer is not necessarily let's sell more, and let's push all these units out of the door, right? Because what it means is maybe we should put an equal amount of emphasis on evaluating our pricing and evaluating our costs, okay? Because sometimes we see maybe the businesses that pursue the strategy of trying to sell a maximum number of units, right, will often undercharge for their product versus overcharge. And because they're undercharging, because they're maximizing the number of units, it means that they're constantly exhausted, right? And then have nothing to show for it at the end of the day. Yeah, they're selling the most number of units, but when they look at, you know, their profits at the end of the day, the profits are often not where they expect it to be, okay? So having an effective pricing model in place will determine whether your business survives or not, okay? Sometimes you may need to experiment with your pricing to determine what the outcome is to your bottom line. And when I say experiment, we're not talking about making changes every month. You need to take some time out to test the success of your strategy, okay? And so what I want to talk about is, you know, within your business, sometimes commit to doing your own analysis offline. And this is an example, this is an example of, let's say you have a photographer with 4 packages, a package costing, say, $100, another package costing $122, and the highest price package costs $182. And you can naturally see that at the lowest package, that photographer is able to sell the highest number of units. And at 182, which is the highest price package, the photographer is able to sell 123 units. So basically 40% fewer units. But look at the graph in the bottom. You could see, for example, you could see that while 200 units results in 200 units at $100 price point, it results in revenues of $20,000. Whereas with the highest price package of $182, it results in revenues of 22K, which is almost 12% higher than the lowest price package. So the importance is, if you have a preference of the highest price package, you want to make sure that you differentiate your product carefully and you explain to your customers as to why this is so unique and what value they get out of it. And that potentially could ensure that your customers will actually pay the higher price. And it means that, it means that you're not exhausted, because here it is in tabular form where I showed with the different price points, the $100 package to the 182 package. It shows the corresponding unit sales, but look at the amount of effort you need to put to get to the 20,000 versus the 22,000, okay? So basically, in terms of price points, the story is simply be very deliberate in terms of how you price your products, right? It's hard to increase prices, so try to get it right the first time, okay? And we know that selling more units will not mean that your revenue will be higher, or it doesn't mean that your profit will be higher either. And prioritizing volume versus value means that you will be exhausted all the time. And most importantly, for service business owners like myself, when you're pricing your services, you need to make sure that you're accounting for all the time and effort that you're putting into the product. You know, in my situation, very often I might be meeting with customers over a 10-week period, but there's a lot of work I do independent of the client. And so it's really important that I take that work into consideration. Otherwise, I'll be working myself to death. And so this is where I want to talk about the cost component of pricing, okay? And we're saying, is it all about the price points? You really have to think holistically, okay? Think about the cost, think about the cost structure of your business, and also think about the mix price, okay? One second. Sometimes I will receive questions from clients where they'll say, do you think it's a good idea for me to increase my prices? Or do you think it's a good idea for me to even lower my prices? And the question I always ask them, I would like to see your profit and loss statement. I really want to understand your cost structure. I can't really tell what pricing makes sense to anyone unless I have a pretty good view of what their organization cost looks like. And so with that, I would like to talk a little bit about the cost of the product. But before I do so, Gilbert, are there any questions in the chat?
Yes, there are a few questions, and one of them has to do with cost. So let me get to that real quickly for you. So let's see what the question was. How do we determine the cost of service?
Okay. In terms of the cost of the service, I am about to get into the cost of products, and I have an example there for you. Okay.
Oh, okay, good. And the next question is, how do we adjust our pricing for inflation, such as gas, overseas competitors, etc.?
I think that's a very good question. And maybe we could answer that question in the next slide or so
Okay,
when we talk about the cost of the products.
all righty.
Okay. And before we go into this section, I would like to ask the question, do you know the profit margins for the individual products of your business? And so what I'm asking here is, if you offer 5 products in your business, do you know the profit margin for 1, 2, or even all 5 products? And if you could answer in the chat, I would like to know. And Gilbert, please help me again.
Yes, I'll monitor the chat for you.
Mhm.
So
Yes
there's
or
no,
no?
there's no questions there. Oh, what was the question?
The question is, I'm asking the attendees of this session, do they
Yeah.
know the profit margins of the products in their business?
Yeah, so 3 people have said yes. Rhonda Jackson said yes. Tarina said yes. Biana Edwards said yes. So yeah, we got a few yeses in there.
Okay, good.
And there's a statement by Brian says, I know we have contract margins as well. So I don't know if you're going to touch on contract margins.
Okay, maybe I'll have to ask Brian more about that.
Okay.
So before we continue into the cost of the individual products, I would like to bring your attention to a profit and loss statement. If you're not familiar with a profit and loss statement, just a high level overview. In a typical profit and loss statement, you have the revenue, which basically represents the products in your business times the price. Then the second section is the cost of sales. And by cost of sales, we're talking about the direct cost that goes into producing the revenue. And for example, if you are a baker and you make cupcakes, okay? If you're a baker and you make cupcakes, you would consider the direct cost as the flour and the sugar and the icing. And also the employees who are actually working on the mix of the cupcakes. So these items go into what we call the direct costs. So with the revenue in this situation of 684 and the direct cost of 572, when you subtract this, you end up with a gross margin of 112. So revenue less cost of sales, 112. And you hear the concept of gross margin percentage. Basically, it is the gross margin divided by the revenue. So that would be 112 divided by a revenue of 684. And that's a 16% gross margin percentage. And in the bottom of the profit and loss statement, I've limited the lines here, is the operating expenses or indirect costs. So for example, the rent that you pay for your storefront, or if you rent an office building, or the IT related cost maybe payroll expenses for the admins in your organizations, all these, or marketing, right? Marketing expenses, all these items go into operating expenses. And the reason why this is such an important document, and I do hope that each and every person on the phone as a business owner, you track your expenses using, say, QuickBooks or even Wave. Wave is a free online, WAVE, is a free online software that allows you to track your financials, because having your arms around your operating expenses especially is so important, because at the end of the day, when you think about the revenues that you generate from your products, less the direct cost, let's assume it's 112, the gross margin, you want to make sure all these indirect costs, such as the rent of the building, the marketing expenses, if you hire an accountant or you pay towards your retirement, all these items need to be covered by this $112,000. Now, for the purposes of this discussion, I'm deliberately showing that the operating expenses are even higher than the gross margins, because the idea is I will walk you through a few examples of some of the things that you could do to ensure that your gross margins are high enough to cover your operating expenses. Okay, now while this is your profit, while this is the profit and loss statement for your entire organization, it is of critical importance that you know the gross profit for each product in your business. So if you have 10 products, right, it means that you need to know the gross margin for each one of the 10 products, because you have to use some level of intentionality in pricing each product. And so you need to know the direct costs for each one of the products in your portfolio. Okay. Now, I know some of you may say, well, what is the most appropriate gross margin for my business? Again, that's a very hard question, because gross margin varies by industry, by product, maybe even in terms of the product life cycle. You know, when you think maybe in the software industry, they have some of the best gross margins, because you find that the cost of sales for software products are very low. But then when you think about the operating expenses in a typical software company, the R&D expenses are so high, right? So at the end of the day, while the margins are high in the software company, maybe the margins are pretty equivalent to many other businesses. Or, you know, we all know that restaurants often struggle. We know that the gross margins for many restaurants are lower than many industries. But at the end of the day, when we talk about gross margin, whatever that is, whether it's high, whether it's low, your operating expenses must be lower than your gross margin. Otherwise, it means that you are operating at a loss. Okay. Then let's talk about direct costs. So direct costs, right, that goes into the calculation of your gross margin. It means, like I said, the cost that is associated with the direct costs associated with that product. So we think in terms of the labor, if someone's making a cake, right? The person who actually bakes the cake, or the direct material, the flour, the butter, the sugar, you know. And then we sometimes talk about supply. So in the situation of a baker, maybe there's a little wrappers or cute little boxes that are used to wrap the cakes. And so that's what we talk about supplies. And I'm just giving a few examples of direct costs. You know, if you're a clothing manufacturer, you know, you would consider maybe the labor cost of the seamstress, the fabric expenses, maybe if there are some shipping expenses, or even things such as, you know, the supplies, maybe the buttons, you know, and the zippers that go into sewing the clothing. In a service business, for example, with a gardener, right? The labor cost of the garden, of course, and you know, if the gardener actually uses fertilizer, you know, for your business, that's part of the cost of sales. And when we think about a boutique, for example, you would consider in cost of sales the wholesale cost of purchasing the pieces of clothing, maybe if you purchase some candles and perfume, and also, you know, if the manufacturers or the wholesalers you're purchasing the product from, they're charging you shipping expenses, you also need to roll that into your cost of sales. And just a reminder before we go into the next section again, what the gross margin is in this situation, I want to remind you that businesses will never meet their full potential if they do not manage their gross margin at the product level. And knowing your direct costs is critical to the success of any business. Okay, and it's unfortunate that sometimes I encounter businesses who don't really know the direct cost of their products, and they may have a price in place, but if you don't know the cost, then the price often is too low to cover the cost. I sat with a young lady in the last year, and she had three major, well, she bakes for a living. And as we went through the exercises, when we first started, she was very adamant that her products were very profitable. But as we walked through the steps of understanding the direct costs, she realized that with the way that she had been pricing her products, she wasn't even covering the direct cost of her product. And let's not talk about there's all the operating expenses that she did not account for. Okay. And Gilbert, I know when you asked the question a little earlier, whether many people were aware of the gross margins, I think a few people answered and they said yes, but I think you had an answer from a handful of people. But it would be interesting to know too, how often do these people evaluate the direct cost of their products? And that goes into one of the questions we even received, where someone says, now we have an issue with inflation and prices are going up. Naturally, this is the time where you should be re-evaluating the direct costs of your product. And when I say re-evaluating the direct cost, get that on paper. Don't do it in your head. I think sometimes we make so many estimates in our heads that the numbers are not precise, but we find that when we put it on paper, we often end up with a very, different picture. Okay, so we talked a little earlier about maybe 2 examples of calculating the direct cost of a product. And in this situation, what I have done, I have provided an example of a wedding cake versus an executive training event. So this is services naturally, and this is a product. Now, as you go through these exercises, we know it's never going to be 100% perfect, but you just need to commit to trying it. And as you do it over and over again, you will get better at it. It's never going to be 100% accurate, but you need to take a stab at the process. So with this wedding cake, notice I have said direct materials, right? Direct labor, overhead, packaging, and supplies. And again, I did not list every ingredient that is used to make a wedding cake, but use your imagination and, for the bakers in the room, when you're doing this exercise on your own, elaborate on the list. Make the list a lot longer. Make sure you've accounted for every item that goes into making that cake. So in this situation, I'm showing, it requires, for example, 5 eggs. And what's the cost of an egg, right? And the total amount. I'm listing the butter and the flour and the sour cream. Now, one mistake that I see many people do is they say, well, I am the only employee in the business, and so I am not going to account for my cost, right? When I'm calculating the direct cost. As your business scales, ultimately, you will be hiring other people to work with you in your business, and you will have to pay them a salary. So that's one important fact why you should account for your time. And also, if you're selling a product to a customer, why would you not want that customer to pay for your time, right? If not, you may as well get a job elsewhere. So you should be accounting for your time when you're calculating the direct costs. So again, with this wedding cake, I have listed some of the ingredients. And of course, in your particular situation, you will list all 10 ingredients that go into creating that wedding cake. You will also list the amount of time it's going to take you to make this cake, your time, also the time of an assistant, times, a decent rate. And direct overhead. What if you're renting a kitchen for, half the day and it costs $300? You have to account for that. And if there are any miscellaneous supplies, right, a tray or a stand, all these items should go into your calculation. Now, in the other example, we're talking about an executive training event. And so with that executive training event, there will be some materials, whether it be a binder or, if there's this broke up an online assessment, right, that's required for every participant in the course. Direct labor, same thing. If you're pricing this executive training event and right, you're the lead, you're the owner of the company, this is a full, I would say an 8-hour event, and let's say it's going to take you 8 hours to put this together, you need to say, what is your cost? Maybe it's about $50, okay? And if you will have to potentially hire a contractor or two to help you through the process, you should account for the cost of the contractor. Okay. And in this situation, you may have to hire a hotel space, you know, a room in a hotel, account for that. And any miscellaneous packaging and supplies, if you're going to serve snacks and coffee to the participants of the event, you should account for that in your direct cost calculation. So this is the minimum floor, knowing your direct cost. Okay. And so when we talk about direct costs, some of the things that we want to account for are production efficiency, right? Making sure that you know, you're consolidating the number of activities that are required. So you're not renting a kitchen for half of the day, but yet you're making one wedding cake. Maybe make a wedding cake and several other treats, right? So you're utilizing that space most effectively. The same applies to labor cost, you know, managing your employees in a way where there's little wasted time. Where volume purchases are concerned, you know, sometimes I speak to small businesses where they say to me, well, I need to make certain purchases for my business. I ran to Ralph's, you know, I really don't have the time to go to the wholesalers. That's a problem, right? You really need to plan out your organization where you're able to minimize the cost of your ingredients. And also, and most importantly, you know, every 6 months or so, you should be locating new vendors, right? Obtaining multiple bids, renegotiating your costs. So you could minimize your direct costs because the layer between your price and your direct cost is all margins, and you want your margins to be as large as possible. And so when we talk about the direct cost, there was a person earlier who talked about, well, what about inflation? What about, you know, the cost of the products? They've been going up, right? So therefore you need to account for those costs as you're doing your calculation. And this is a great time to actually consider making some changes to your pricing, because every time I go to the supermarket or the gas station and everywhere else, everyone is using the excuse of inflation. And so why not you? Okay. And the next item I would like to address is product mix. And when I say product mix, I'm talking about within every organization, you do have several products that you offer to your customers, right? Oops, sorry. You do have several products that you offer to your customers. You need to make sure, as I said a little earlier, that you understand the gross margin for every product in your organization, because if you don't, and you're managing at the very high level, for example, if your bookkeeper hands you a profit and loss statement every month and it says, well, your gross margin is 16%, and you say, okay, I'm done. No, whereas you need to understand all the components that go into making that gross margin, because you will be surprised and stunned, right, by the actions you could take to improve your overall gross margin if you know what's happening within the business. So this is an example of a business that has 5 products. And the way I've structured this, the size of the bubbles also reflects the proportion of the mix, right, that occurs in a business. So therefore, we have in total, let's say, a little over 2,000 units in this particular company. 1,300, let's say 1,360, which makes up about 56% of the mix, has an average gross margin of 42%. So these are the products, right? 56% of the units have an average gross margin of 42%. And that's really important to understand. Whereas there's another 44% of the mix, this product here and this product here that you see are being sold at a loss of a minus 23% gross margin and minus 13% gross margin. And so your question, you have to ask yourself several questions before you make decisions. You need to say, did I intentionally mark this product at a price where I'm reflecting a gross margin of 13%? Or, is it intentional or is it coincidental? Because earlier in the presentation, I talked about, for example, Hewlett-Packard and the way Hewlett-Packard prices the printers at a complete loss versus the toner and the ink, right? So that's intentional pricing. If that is the case, it's okay. But if this is because maybe you didn't take the time to do your homework and you're seeing that 8% of your mix is being marked at a loss of 13% GM, and also another 23% of the mix, right, is being priced at a 23% margin. This is where you really want to consider whether you could make some changes to this situation, okay? Another thing, besides the example of HB, if this were a situation where this was a printer, right? If HB made the decision not to sell this printer, naturally the prices of its, the revenue and profit that it earned from the toner and the ink products would be impacted. But if this is not a loss leader and it will not impact the demand for these products up here, you should really consider making a definitive decision to probably remove some of those products from the mix. So for example, this is the before where we have 2,400 products in the mix, right? 2,400 products in the mix. I'm saying, here, the green portion has a 37% gross margin. This one has a 59% gross margin. This portion over here has a 41% gross margin. But as I explained, on the other side, we have this portion and this portion, right, with that were priced at a loss. And I said, hey, is there a possibility where we could shift the demand for some of the volume here? This is not a loss leader situation. This is, let's assume you're in a bakery and they have several different croissants, right? They have a chocolate croissant and a blueberry croissant and I know it's ridiculous, but a caviar croissant. If you say, well, the caviar croissant is being sold at a loss, so let's get rid of it. If we get rid of it, maybe we're gonna lose some customers. We'll lose some customers because some customers will say, I'm here for caviar. If you're not going to give me any caviar croissants, I do not want anything else from you. And sometimes that's okay, put the numbers down on the paper and understand the impact, right? So what I'm saying here is we're getting rid of this yellow section here, and we're getting rid of this section here. But hopefully we will keep some of the customers. So at the end of the day, while we've gotten rid of these two sections, we've been able to retain some of the customers. So we went from 2,400 units to 2,000 units, okay? And what's the impact of that? So I'm saying in this particular situation where we went from 2,400 units to 2,200 units, we've lost 8% of our volume because some customers have said, I can't do without my caviar croissant. I'm sorry, right? I cannot go to the blueberry or the chocolate. So what happened, because we lost 8% of the volume, our revenue actually declined by 13%. So our revenue went from 684 to 596. But interestingly, our margin went from 112 to 240. So we went from a 12% gross margin, okay, to a 40% gross margin. And so ask yourself the question, is it more important to you that you maximize revenue, or is it more important that you maximize gross profit? Because you could see here in the original scenario, we had revenues of 684 and margins of 112. Now our revenue is 596 with gross margins of 240. Okay, so our margins are better, and you need to make a decision for yourself if you're happier with the fact that you're left with more margins while your revenues are lower. From my perspective, I'll take the margin, and I'm okay with the fact that my revenues are a little lower. It's all about the profit. So this is another scenario where I have said that what if we apply a 5% increase on top of the actions that we took in the previous slide, right? So we eliminated 2 products in the other scenario. And in addition, we're increasing our prices by 5%. So you could see now that in the old scenario, we had 2,400 units. Now our volume has even declined even more, right? Now to 2,176 instead of, I think it was 2,200. So again, our volume is down, our revenue is down, but now our margins are even better. Okay. And recall that I said every 6 months or so, you need to evaluate the cost of the ingredients for your products. See whether there's a way you could source your products at lower prices, reevaluate where you get the ingredients from. As a business owner, that's part of working on your business. As Gilbert always says, work on your business. Work on your business periodically, right? By figuring out your pricing strategy, figuring out the cost of your products. So this is the third dimension where with a further improvement in the cost structure, what happens is our gross margin is even better, up to 288. And basically, this slide is a combination of showing, okay, we first started with 112,000 in gross margins. When we refined the portfolio, our margins went up to 240. Then we applied a 5% price increase, which is, entirely okay and excusable right now. With inflations, we see that the margins went up even more. And then with the cost improvement, a further increase. And look at the percentages. We went from 16% to 40% to 43% and 47%. When I'm evaluating financials, I don't only look at the absolute numbers. I always look at the percentage, because as you scale, as you increase the revenues of your business, you should be striving to show better gross margins or profit margins on a year-over-year basis. So basically, in summary for this section, what I'm saying, some of the things that you should consider is know the gross margins for the, not even just the top selling products, because you cannot set a price for any product that you sell if you don't know the cost. So you need to know the cost in order to determine what the price is, right? And limit or eliminate, if possible, any low margin products. And we've talked about exceptions where it might be okay for you to keep low margin products in your portfolio. And always perform benchmarks. I'm not saying that you should mirror the pricing of your competitors, but you should just understand what your competitors are doing from a gross margin perspective or profit margin perspective. And if needed, consider a price increase. Gilbert, could you check to see if there are some questions in the chat, please?
Oh yeah, we got quite a few questions here.
Okay.
So I'm gonna start from earlier in your presentation. So one person, Vivian Bauer, said, are your utilities and insurance part of the direct costs or operating expense?
Operating.
Okay, you got that, Vivian? Operating.
And we'll get to operating expenses in the next few minutes.
Okay, the next question is from Elnora Rogers. And her question is, what is the priority for pricing? Is the most important thing to consider the person that you're selling to? And if that customer is female, making over 100K versus 25K.
I think it depends on the product. It depends on the product. For example, everybody needs a bagel, right? Doesn't matter whether the end consumer makes 25,000 or whether that end consumer makes 50,000. Whereas if you have a highly luxurious purse, it would be more important that you evaluate the income of your customers. So it depends upon, it's a hard question to answer. Would really have to figure out what the exact product is in order to answer that question adequately.
Okay. And Ronell Hampton says, I do have some of this. I didn't do the percentages, but I subtracted my staffing cost from the cost of my workshops because my team is paid by contract. I don't think I have the other costs connected to the gross margins.
Okay, so is that a question or just a statement?
I think he's making a statement and probably trying to get some reassurance from you as well because of what he's doing with his costs in his workshop.
Okay.
So he said he subtracted his staffing costs from the workshop costs, and that's how he handles his financials.
Okay, the staffing, and if the staffing actually performs a workshop, yes, it should be considered. And Gilbert, it's important for us to also make the statement, and we will highlight that issue to the end of the presentation, that we do have some homework assignments, and we will also give the team the opportunity to speak directly to me in the next week if needed, so I could answer your unique and personalized questions.
Excellent, excellent. And one more question before you continue is, does the labor include payroll taxes and workers' compensation insurance?
Yes, I would
That's,
include that. Yes.
that's from Vivian Bowers. So Vivian,
Yes.
there's your answer. Answer is yes, Vivian.
Yes, I would do that. Yeah.
Okay, you may continue.
Okay. So in the next section, I would like to focus a little bit on operating expenses. So just as you can recall, we talked about revenues a little earlier, less the direct cost of sales, which gave you profit, gross margin. Remember in the exercise we did, we got up to almost like a 43% gross margin when we increased prices. We removed some of the products, some of the unprofitable products from the portfolio. So now let's focus on operating expenses, because effective pricing is a holistic issue, right? Your pricing and the associated gross margin needs to cover the cost of your operating expenses. And as we know, operating expenses very often are very fixed, and they will happen, right? Regardless whether your revenues are cut by half or not. COVID. Okay. And when we talk about indirect expenses, we talk about expenses that apply to more than one business activity. And so some of the expenses, travel, and maybe marketing, education, equipment, insurance, utilities, rent. Okay. And it's really important when we talk about operating expenses in your business, you are so responsible, right, for understanding intimately what the operating expenses are for your business. You need to be so intentional on how much you spend in operating expenses, because very often we see that many business owners are unable to meet profit goals simply because of mismanagement of their operating expenses. Okay, and what I generally ask my business owners to do is, on a monthly basis, or there are business owners who even do this, say, on a weekly basis, downloading, and I do hope, and I think I mentioned that before, that many of you have access to an online financial software like QuickBooks, or there's a free one called Wave. I know, Gilbert, we have Crystal, who provides, I think, periodically QuickBooks and Wave courses, and she could provide some mentorship to you if you need some help in managing your expenses in QuickBooks, because in my opinion, it is very hard for you to manage a business if you don't have your arms around your operating expenses, okay? And so I would say you start by, put in your expenses in some sort of a spreadsheet, get it from QuickBooks, somehow get it from your bookkeeper. Or if your bookkeeper does a pretty good job of providing you with that information on a regular basis, don't have it sit in your inbox. You need to study it. okay? What you should also do with that information is understand and categorize those expenses. Figure out what's variable and what is fixed. Okay, that's an important distinction, because when we think about differentiating between fixed and variable expenses, fixed expenses are, it doesn't matter if you sell one product or if you sell 100 products in your business, you will have to pay for it anyway. You know, think about March last year, was it last year? March and April of 2020, when many of our businesses came to a halt. What happened? You still had to pay the rent on your building, right? There were certain things you had to pay regardless what you sold. And these are the reasons why I'm saying it's really important that you pay attention to this activity on a monthly basis. Also, another thing I typically suggest is there's a lot of recurring expenses that occur in your business, and sometimes you don't even utilize those services. So think of yourself, put yourself in the shoes of a consumer. We all have subscriptions to Netflix and maybe Hulu and maybe what's the other ones? You know, we have so many subscriptions, and sometimes we don't even utilize the services, right? But yet the bills come every month. Every month, the charges hit our credit card. So there's no differences between you being this consumer being hit with Netflix and Hulu and whatever, right? Versus being a business owner where you've subscribed to some services and you see the charges come through every month. Well, because you're not paying attention, you're not seeing those charges come through and you're paying for those charges. Okay. Another thing is when you look at your expenses, you should categorize those expenses by considering whether some of those expenses really make a difference to your revenue or whether they're like an unnecessary expense. So for example, their expenses, maybe I would say some marketing expenses that really contribute to an improvement to your revenue. These are expenses that you probably would continue to invest in on a regular basis, but you need to eliminate the ones that you don't see an ROI from, right? And think about all the days where many of us, go on these glamorous training trips, right? For travel, we incur all these expenses and you learn a substantial amount of content while you're spending money in hotels. And when you go back to the office, you don't implement anything that you learned, right? So in other words, that's not an investment. That's just an expense that should be eliminated, okay? And another thing that I do is I always look at the expenses as a percentage of revenue. So I'll go to the next line. So this is a typical profit and loss statement, right? I'm trying to use the same example. We have marketing, we have travel. I find that it is very useful to look at each item, each operating expense item, and understand the relationship between that item and the revenue. So in this situation, marketing is 7% of revenue. Probably it's okay, but I get a little worried when I look at the year-over-year growth. So it says to me, if marketing is increasing by 178%, it means that we spent about 18,000 in marketing in the prior year, and now we're planning on spending 50,000 in marketing in the current year. That's 178% increase. you probably want to understand this. Oops, sorry. You probably want to understand this trend a little closer. You look at all the items, right? And you make sure that these items that are shown here, there is a direct correlation between the spend and the revenue. Notice, and I love to do this for businesses, is we know some of us, right? Some of us went into business in order to generate wealth or build wealth. And so because of that, it's important that you always account for payroll, you account for retirement, because this is something that should be happening every month. And also, I also included a line for meals and entertainment. Very often, I see businesses who spend a lot of money on entertainment and food, but there's no return. And the response I typically get is, but I'm going to get a write-off. That doesn't mean anything in my mind, right? More importantly is, how profitable is your business? Okay, a write-off means that you're taking money out of your pocket when you should really be putting it into your retirement. Okay, and one more thing where I highlighted marketing of 50K. Notice I listed the different types of marketing activities, and I tried to compare the year-over-year change. And you may want to do that type of evaluation, explode that number, just to make sure that it really makes sense for your business. Okay, and again, we know that we still have an issue because the operating profit here is still not acceptable. It's at 71%, right? I mean, minus 71%, which represents a 10% loss. And even worse, there's a year-over-year growth, which shows that our margins are worse by almost 6 points year-over-year. So going to the next slide is when we talk about operating expenses, we have to be very intentional on what we spend, how we spend it, whether the spend really contributes to an improvement to our revenue, or maybe makes us more productive, right? You should be evaluating, potential savings every month and create some spend metrics for your business, and when I say spend metrics, I think of in terms of, what is acceptable? Is it acceptable to spend 5% of your revenues on marketing, or 20% on marketing? How much should you spend on travel? Figure out what those metrics are, do some benchmarks, and make sure that you measure throughout the year to your plans. Okay. So basically in this slide, what I'm trying to do is I'm showing and I'm integrating all the changes that we did, right? So remember, we started with the scenario of revenues of 684 and gross margins of 112 and operating profit of 71. And we know that's not sustainable. So we talked about several things that we were able to do in order to improve the gross margin. And as a reminder, some of those items included evaluating the portfolio of products, removing the products that was driving down the portfolio average. We also integrated a small price increase And we also looked into cost savings ideas. So therefore, our gross profit went from 16% to 47%, which represented a 27% growth. And one thing I think I mentioned that before, don't only focus on your dollars, you should focus on the rates also. And then where the operating expenses are concerned, we were planning on 183,000. So we were able to evaluate a little more, and we were able to take those expenses down to 167. And that was affordable considering that our gross profits went up quite substantially. And so at the end of the day, some of the changes that we made, we exploded the marketing line item, because I know marketing is the sexiest thing in the room lately. Lately, every time I go into on Facebook or LinkedIn, and the question comes up, what do you need to do in your business? Immediately, everyone says marketing, but yet marketing is critical, right? Sometimes people say marketing is the oxygen in the room, but you have to spend wisely. Not every marketing activity is appropriate for your business type. And you can see here, we reduced travel, for example. Rent, we kept pretty much the same. Retirement, that's one area where I believe as a business owner, you need to maximize as much as possible. Meals and entertainment, that's a mistake. I noticed I actually took meals and entertainment to 13K from 10K. That's a mistake on my part. I would never recommend that to a business owner. But again, on a regular basis, evaluate your spend as a percentage of revenue. Keep in mind the increases from a year-to-year basis, okay? And we all know that depending upon where you are in your business, these ratios will vary. Businesses who are in the earlier stages may spend more on marketing, but over time, when you've established a pretty good, loyal customer base, you might, as a percentage of revenue, you may find that number might need to go lower. So there's a few changes. But in summary here, when we talk about pricing, it's all about being very intentional about pricing. It could basically make or it could break your bottom line. Don't gravitate towards the lowest price. That is not a good strategy. As much as possible, you should understand what your customer needs are. You should really communicate the value that you bring to your customer's problem, and price your product or service accordingly. It's really hard as small businesses to compete on the lowest price, okay? And more importantly, you need to know the cost of sales, the direct cost, and the gross margin for each and every product in your portfolio. And you need to review your operating spending on a regular basis.